Usually when we talk about a safe haven or like a financial safety net, there's this expectation of absolute unshakable security.
Right, yeah, like a bunker.
Exactly, like a reinforced concrete bunker. You close the heavy steel door, you spin the combination lock, and the architect just points at it and says nothing is getting in there.
Right. It's totally impenetrable. It's, a binary state. Locked down or not locked down.
Yeah, but then you step into the actual world of investing specifically, defensive investing to protect your wealth, and suddenly that bunker door has like a dozen different keyholes.
Oh, absolutely.
And you're not entirely sure who holds the master key.
Mm.
We're looking at a landscape for securing your assets that is honestly a lot more complicated than just digging a hole in the backyard and burying a box.
It really is. It is the absolute definition of financial muddy waters.
So for you listening right now, if you're trying to figure out how to actually protect your wealth in a turbulent system, we are doing a deep dive into a comprehensive source document today. It's called The Essential Guide to Strategic Silver Investment.
Yeah, it's a great breakdown.
And the mission here is we are skipping the generic financial advice. We really want to figure out exactly how the mechanisms of these investments actually work and what makes sense for your personal goals.
Because historically, precious metals are that go-to safety net. When the economy wobbles or geopolitical events cause uneasiness, people look for stability outside the traditional banking system.
Right.
And silver is particularly interesting because it's a powerful tool to diversify a portfolio. It's a great hedge against inflation, but, and this is key, the specific vehicle you use to buy it completely changes the type of risk you are taking on.
Okay, let's unpack this.
Yeah.
Because the text gives us a roadmap with basically 4 main paths we can take. We can physically hoard it, trade it as an ETF, bet on futures, or buy into the mining company.
Exactly. Those are the 4 primary avenues.
So if I'm looking for ultimate security, my brain immediately goes to the first one.
Yeah.
Just buying the actual physical metal, not, the pirate chest or dragon hoard fantasy, but the modern equivalent.
Right.
Like buying a bunch of silver bars, shoving them in heavy-duty PVC pipes, and burying them in the backyard, or at least stacking them in a heavy floor safe.
Well, there are undeniable pros to physical bullion or coins, as the guide points out. There is no pure way to own an investment.
Because it's tangible.
Exactly. You aren't relying on an internet connection to prove you own it. You aren't relying on a third party to manage it for you.
Yeah.
If the power grid collapses or the banking system freezes up, the physical asset still exists right there in your hand.
I mean, I get the appeal of being your own bank. I really do. But I have to push back a little on the romance of it.
Oh, how so?
Because to me, buying physical silver feels exactly like buying a pristine, fully restored vintage car.
Okay, I see where you're going with this.
Right. It's incredibly beautiful. It's great to look at. But then you realize you can't just leave it parked on the street.
No, definitely not.
You have to pay to rent a secure, climate-controlled garage. You have to buy a massive safe or pay a bank for a deposit box. The maintenance and security suddenly become a massive headache.
That is a perfect analogy, and the hard numbers from our source completely back you up on that. Investors simply aren't factoring in what we can call the vault tax.
The vault tax.
Yeah. To start, you pay an average of 5 to 6% in commissions just to acquire the silver coins and bullion in the first place.
Well, wait, 5 to 6% right off the bat. So you are instantly starting your investment in the red.
Exactly. The dealer needs to make a cut,
Wow.
The text gives specific examples like the 1-ounce American Eagle coins produced by the United States Mint or coins from the Royal Canadian Mint. Those are wildly popular.
They're the really recognizable ones.
Yeah, but they sell at a stiff premium over the actual spot price of silver on the global market.
Huh.
You are overpaying for the metal just to get it shaped into a recognizable coin.
So I pay a premium to acquire it, and then I have to pay to build a garage for the vintage car.
Right. Safety deposit boxes at banks carry an annual fee. If you use a precious metals IRA or a custodial account, those come with yearly storage and auditing fees too.
It adds up fast.
It does. But beyond the storage costs, the real friction point is liquidity. Imagine trying to quickly sell off 50 pounds of physical silver to capture a spike in the market.
Right. I can't exactly swipe a silver bar at the grocery store. I have to physically lug a heavy duffel bag across town, hoping the local pawn shop or coin dealer is actually paying the current up to the minute spot price.
And they often aren't. Physical dealers have bid-ask spreads. They buy it from you for less than the market rate so they can turn around and sell it for a profit.
And this seems especially problematic with silver specifically, right? Because unlike gold, silver isn't just a shiny paperweight. It actually does things.
Yes. What's fascinating here is that it's highly conductive, which means it has massive industrial demand. Unlike gold, which is seen almost strictly as a static store of value, silver has established uses in the automotive sector, across various electronics and solar panels, and in photography.
Which means the price isn't just based on people being scared of the stock market. It's based on, like, how many solar panels are being manufactured this quarter.
Precisely. And that demand is expanding. The source highlights new technologies like silver oxide batteries, silver conductive inks, and various silver-based nanotechnologies used in medical applications.
Wow, okay.
So because it is an industrial component, the price is inherently volatile. Manufacturing booms and supply chain hiccups make the price jump around.
And that volatility makes the liquidity problem so much worse.
Absolutely.
Like if the price spikes on a Tuesday because of a sudden tech boom and I want to sell right then to capture the profit, I can't do it instantly if my silver is buried in the backyard or locked in a bank vault that closes at 5 p.m.
You simply can't move fast enough to capture the peak.
So if physical silver is too heavy, expensive to store, and way too slow to sell, Wall Street must have invented a way to turn it into pixels that I can trade instantly, right?
Yeah, they definitely did.
There has to be a modern solution to get exposure to the price without throwing out my back.
They absolutely did. That brings us to exchange-traded funds, or ETFs.
Yeah.
This is the digital convenience route.
Okay.
Funds like the iShares Silver Trust, which trades under the ticker SLV, or the Aberdeen Standard Physical Silver Shares ETF, ticker SIBR.
So if I'm not buying a physical coin, what exactly is Wall Street selling me? Am I just buying a row on a spreadsheet?
Mechanically, you are buying shares of a trust. The fund managers take investors' money, buy massive institutional-sized bars of physical silver, and store them in highly secure vaults in places like London or New York.
Got it.
Then they issue shares that represent a tiny, fractional ownership of that massive silver pile. You can buy and sell those shares instantly through an online brokerage account, often with zero trading fees.
Problem solved. No safe, no pirate chest, total liquidity.
It is incredibly accessible. You completely bypass the 5 to 6% dealer premium of physical silver. You buy in at roughly the actual spot price, and the yearly fund expenses are incredibly low, sometimes just 0.5% a year.
Here's where it gets really interesting, though. I'm picturing a major catch here.
Go on.
With an ETF, I'm essentially just holding a digital coat check ticket. I hand over my money, they give me a ticket that says, hey, we have your silver.
Right.
But what happens if the restaurant burns down? Or the guy running the coat check makes a bad bet and goes bankrupt? I don't actually own the coat, do I?
You've hit on the exact vulnerability. What you are describing is called counterparty risk.
Counterparty risk.
And it is the biggest drawback of ETFs, and especially exchange-traded notes, or ETNs, like the UBS eTriCS CMCI Silver Total Return ETN. You're trusting a third party, the counterparty, to actually have the goods, store them properly, and honor the digital ticket.
So if the financial system locks up, my coat check ticket is basically worthless paper.
Yeah, shareholders don't actually own title to the metal itself unless they are a massive authorized participant in the fund. And the text provides a chilling, real-world example of exactly what happens when that third-party promise breaks down.
Oh.
The MF Global bankruptcy in late 2011.
Wait, what actually happened mechanically with MF Global?
So MF Global was a major financial broker. Investors held warehouse receipts for physical silver bars within MF Global's accounts.
Okay, so they had the receipts.
They thought they had the ultimate safe haven because they literally held the receipts for the metal. But MF Global was making incredibly risky bets with its own corporate money, completely separate from the silver vaults.
Oh, no.
When those bets went bad and the firm went bankrupt, the bankruptcy court stepped in and froze everything.
Wait, but the court couldn't touch the silver, right?
Yeah.
Investors had the receipts for their specific bars.
Well, the court pooled all the assets together to figure out how to pay off the firm's massive debts. The liquidating trustee eventually paid those silver investors out at about 72 cents on the dollar.
So because the middleman made bad bets in other areas of their business, the silver investors lost 28% of their doomsday insurance. Just completely wiped out.
In a flash. They lost 28% of their physical bullion value because they relied on a third party's vault.
That is insane.
It completely undermines the #1 reason most investors choose precious metals in the first place, which is defense against systemic failure. If your insurance policy vanishes the moment the financial system experiences stress, it's not a very good policy.
That is brutal.
And beyond the catastrophic risk of bankruptcy, ETFs have a slow, quiet leak built into them. To pay for the vault storage, the insurance, and the fund manager's salaries, the ETF has to periodically sell off small portions of the underlying physical silver.
So the actual pile of silver backing my digital share is slowly shrinking.
Yes, it's called decay. Over years, one share represents slightly less silver than it did when you first bought it. This eroding effect causes the share prices to track slightly lower than the actual spot price of silver over the long term. You bleed value slowly to administrative fees.
Okay, so physical silver traps me with logistics and premiums, while digital silver exposes me to counterparty risk and fee decay.
Exactly.
What if someone just wants to treat silver purely as a financial wager? No vaults, no coat check tickets, just placing a bet on where the price is going to be 6 months from now.
For that, you step into the world of futures contracts. A futures contract is a derivative. You are not buying silver. You are signing a legally binding agreement to buy or sell a specific amount of silver at a specific price on a specific date in the future.
So if I agree to buy silver at $30 an ounce in December, and come December the market price is $40, I make a killing because I get to buy it for 30 and instantly sell it for 40.
Right.
But if it drops to 20, I'm forced to overpay.
Exactly. But the real reason investors use futures isn't just to lock in a price, it's leverage.
How does the leverage actually work in this context? Because, financial people throw that word around constantly, but what is the actual mechanism?
Leverage means you only have to put up a tiny fraction of the contract's total value, which is called the margin, to control a massive amount of silver.
Okay, run the numbers for me.
Let's look at the math. A standard silver futures contract on the COMEX exchange is for 5,000 ounces. If silver is at $30 an ounce, that single contract controls $150,000 worth of silver.
Right.
But the exchange might only require you to deposit $10,000 into your account to hold that contract.
Wait, wow. So for a $10,000 deposit, I get the profits of a $150,000 asset. A tiny bump in the price of silver could double my 10 grand overnight.
But here's the catastrophic downside.
Yeah.
The losses are also based on the $150,000 value, not your $10,000 deposit.
Oh.
Let's say the price of silver drops by just 7%. The value of the silver in that contract drops by over $10,000.
Wait. So a mere 7% dip in the market completely wipes out my entire investment. My 10 grand is just gone.
It's worse than gone. Because you don't just lose your initial deposit.
What do you mean?
If the price keeps dropping, your account balance goes negative. You experience what's called a margin call. Your broker essentially picks up the phone and demands you wire them thousands of additional dollars immediately to cover the difference.
And if you don't?
They aggressively liquidate your position and sue you for the remaining balance.
So it's not just, I lost what I put in. I could end up owing the broker massive amounts of money just because silver had a bad Tuesday.
Absolutely. It is an incredibly complex and dangerous arena for anyone who doesn't do this professionally. You are taking a so-called safe haven asset and turning it into one of the highest risk wagers on Wall Street.
Yeah, that sounds terrifying.
Plus, futures contracts expire. If you want to hold the bet long term, you have to keep paying fees to roll your expiring contracts over into new ones.
Okay, so if we aren't willing to risk owing our broker 50 grand over a margin call, but we still want to wager on the silver market without actually touching the metal, what about the companies pulling it out of the dirt? Mining equities.
Buying shares in silver mining companies is an indirect investment. You're buying a piece of a corporation, not the commodity itself.
Right.
The major benefit here is portfolio diversification. A company's stock is driven by dozens of factors, so it won't move exactly identically to the price of silver. You can hedge your bets.
I have an analogy for this one too.
Let's hear it.
Buying mining equity is like investing in a bakery instead of buying a bag of flour. If I own the flour, its value just tracks the market price of flour. But if I invest in the bakery, I'm relying on the baker showing up to work, the supply chain for sugar, the neighborhood foot traffic.
Yes. You are introducing massive business operational risk.
Right, because if the bakery's oven explodes, the bakery goes out of business, even if the global price of flour is skyrocketing.
Exactly.
So if I buy stock in a silver miner, I could lose my shirt, even during a massive silver bull market.
That is the harsh reality check the source material emphasizes. Imagine the global price of silver booms. You'd assume your mining stock would boom too. But what if that specific company faces a severe cash flow deficit?
Right.
What if their primary drilling equipment suffers a catastrophic failure, halting production for 6 months? Or there's a prolonged labor strike at their biggest mine?
Their stock is going to plummet, regardless of what the metal is doing on the commodities exchange.
Precisely. You also have to factor in uncontrollable geopolitical forces. Let's say a government in a silver-rich region suddenly passes strict environmental regulations banning open-pit mining, or they abruptly raise taxes on foreign mining corporations. The mining company operating there takes a massive hit.
Ironically, if a major government bans mining, that restricts the global supply, which probably makes the actual price of silver skyrocket.
Exactly. The physical commodity goes up, your mining stock goes down. You are suddenly exposed to labor relations, the cost of diesel fuel for the trucks, corporate debt, and geopolitics, a whole different world of risk that has nothing to do with the intrinsic value of silver itself.
So what does this all mean? Summarizing the ultimate trade-off here for you, the listener, it all comes down to control versus convenience.
That's the perfect way to frame it.
If you want absolute control, physical coins and bullion give you true off-the-grid ownership. But you pay dearly for that control, with high dealer premiums, the headache of vaults, and severe illiquidity.
Yeah.
If you want convenience, ETFs give you instant digital trading, but you trade away your control. You accept counterparty risk, and you could wake up to find a bankruptcy court has sliced off 30% of your doomsday insurance.
And stepping away from the physical metal entirely, futures offer massive leverage, allowing a small deposit to control a fortune in silver, but they carried the extreme danger of margin calls wiping you out. While mining stocks offer a way to profit from the industry, they blindside you with messy operational and political risks.
It connects directly to what job you want this investment to do for you. Are you an aggressive trader looking to use leverage for high-risk returns? Or are you looking for a tangible physical safety net because you fundamentally don't trust the stability of the banking system? You can't have both in the same vehicle.
Which leads to one final, much broader question about the future of this asset, a concept that steps slightly beyond the immediate trading strategies and looks at the horizon.
Oh, what's that?
The source text heavily emphasizes silver's accelerating role in cutting-edge technology. Conductive inks, advanced solar panels, medical nanotechnologies. The industrial demand is eating up more and more of the global supply every single year.
Right, we talked about how that industrial demand makes the price way more volatile than gold.
But if we extrapolate that forward, could we reach a tipping point where silver completely loses its historical identity as a precious metal?
Oh, wow.
For 5,000 years, human beings have looked at silver as a mystical store of wealth. But as technology advances, does it become strictly an industrial commodity? Think about the worst-case societal scenario that people are insuring against. If the world truly goes sideways, will future generations value a silver coin because it's shiny and represents ancient wealth?
Or will they value it simply because they desperately need the raw material to build and power their survival technology?
Wow.
Are you holding a piece of history, or are you holding an unrefined battery component?
That completely changes how you look at those heavy PVC pipes buried in the backyard. Something to think about the next time you're weighing a digital stock ticker against a physical coin.